Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Consumers still have the ability to spend. Canadian retail sales show a decrease through the month of May. However, preliminary data from Statistics Canada points to higher retail sales results for June. This is all in Canada. When we dig into the US subsectors on the consumer side, which new trends are grabbing consumer attention? Does the second half of this year look better than the first for American consumers? And in such an environment with tariffs, can a quality brand innovate and market themselves to pull away from the crowd? Joining us today to figure out where U.S. consumer discretionary purchases can translate into returns for investors and perhaps where they can't is Fidelity equity research analyst Cameron Ho. Cameron covers the U.S. retail and apparel sectors. Welcome, great to see you here.
Thank you for having me, Pamela.
Delighted to have this chance to have a conversation with you. So American consumers are still spending. The economic story actually is often better than people think, and a recession for now seems to be way on the side. What would be kind of an opening remark on the health of the consumer in the US?
Well, I think the US consumer and consumption is extremely important to the health of the economy and the stock market overall. And I think the trends that we've seen year to date have been surprisingly positive. And I think that's a function of two factors. One is that the job market remains relatively healthy. And I think secondly is that the inflation picture has been relatively benign. And so what I'm hearing from my companies is that certainly there's headline risk, there's the CNN effect where the consumer is potentially distracted, cautious, but at the same time they are willing to spend for the items and the brands that they covet. And so that's a picture as we sit today. But I think what I'm watching is, everything we've seen to date has been the result of that benign inflation environment, but with tariffs really could potentially change the picture significantly. We have yet to see the full brunt of tariff-driven price increases hit the US consumer. And so to the extent that those price increases flow through later this year and inflation accelerates, that could change consumer spending patterns markedly.
Would you say consumer spending patterns right now have slowed at all? It's still robust enough, but what, I guess, nuances have you noticed about the consumer that would point to their health or otherwise? Are there different types of purchases they're making or not making?
Mm-hmm. Well, I think first and foremost, what's created a great environment for stock picking is that the consumer uncertainty has created a greater separation between the winners and the losers.
Oh, interesting.
The brands that have very strong innovation, very strong brand heat are continuing to win and attract the lion's share of the consumer's wallet. And at the other end, it's accelerated the decline of those who don't necessarily have the brand power or the innovation, and consumers have just sort of started to slowly forget about those brands. And I think if you want to divide it by income cohort, I think we're at a very interesting point here where, as I mentioned earlier, consumer spending is largely a function of employment and wage growth. And I'm watching the low-income consumer very closely. Because, up through last year until maybe the end of last year, we saw lower income cohort, their wages were growing more quickly than perhaps other cohorts, and that has reversed. And so now we've seen, in 2025, lower income wages are growing more slowly than other cohorts. And that potentially poses risk to the extent that continues later this year.
In other areas within the spectrum of how you look at consumers, maybe higher end, maybe not, maybe those that are just investing along the way. They're not necessarily the wealthy customer, but stock markets look good. Is there sort of a confidence that comes from that?
I think for the middle to higher income consumer who is less dependent on pure employment and has a greater base of savings, stock market strength year to date is certainly a tailwind for them. Historically, what we call the wealth effect has driven strong consumer spending for that higher income cohort and has been a benefit to the companies that primarily target and serve those consumers.
That's really interesting. You mentioned innovation earlier on. Innovation is in terms of the products themselves, or this is more companies becoming, better at marketing communication, that kind of thing? What type of innovation do you mean?
I think product innovation is, I think to have a brand that consumers are willing to pay up for, to have pricing power, you need two things. You need a great product to sell, and that's a function of R&D and innovation spend. And secondly, you need a story around that, a brand. And I think I can cite, later if you want to go into it, different examples of innovation at the cutting edge that many of my companies are bringing forward But I think the important thing to note is that those are long-term decisions. You don't create a product overnight. Lead times in the sector, in my sector, are, to bring a shoe to market from conception to shelf are at least 18 months. And so the investment needs to be made today for things that will pay off in the future. And so when it comes to picking stocks, I think it's critically important for people in my seat to meet with management teams regularly, as I do, and understand who amongst the coverage of the 20, 30 management teams that I cover, who is truly long-term and which CEOs are truly committed to putting forward that investment now, potentially at the expense of profit margins near term, in order to receive the payoff over a multi-year view.
Can you give us a couple of examples of something that's more innovative in terms of a product that's either come through or that's in the works, perhaps?
Yes.
But maybe you're not allowed to tell those secrets. But something that's come recently to market that is an example of that.
Absolutely. I'd say, for example, is a company or a brand that's based in Western Canada. And they recently came to market publicly with, something that's very cutting edge, and it's not, I think, expected to move the needle on the company's performance in the near term, but it stands as a very important example of their commitment to innovation. And that company has come out with a pair of motor-assisted trousers or pants for hiking. So if you just need a little bit of extra strength, or if you're older, they will help you and give you extra power on the ascent and protect your knees on the way down.
Magic trousers, really?
Magic trousers,
like
exactly.
From Forrest Gump. That's incredible. Yeah. So actually, it helps you climb a hill or a mountain?
Exactly.
Really?
Yes.
That's fascinating. Okay, as you say, that's sort of an example of innovation. What about on the slightly more marketing side of things, on what they need to make sure they're doing to keep their brand top of mind?
I think, I am no longer at the forefront of consumer trends due to my age.
Did you grow out of it?
I've outgrown that cohort. Now today it's all about Gen Z. And I think the brands that are succeeding today are successfully capturing Gen Z or Z, since we're in Canada. And I think the very simplest way to measure that as an analyst is how much of your P&L are you investing in marketing. And I think one of the most successful accessory brands in the US in the market today used to spend 3 to 4% of their sales on marketing pre-COVID. And today that number is more like 9, almost 10%.
Really?
And that investment has paid dividends, in terms of the acceleration in top line growth that they've seen, the reduction in discounting, the increase in profit margins. And so going back to the earlier point, it's really the investment the decisions that you make several years prior that pay off on a multi-year view.
What were the several years prior decisions that were made to see the Western theme be so forefront? It appears lots of denim.
Certainly.
Yeah.
I think their fashion trends today are, I've gone back and studied fashion trends based on search interest data and other indicators, and it seems to me that fashion trends on average will last for 2 to 5 years. Okay. And I think in this day and age with social media, fashion trends are catching on sooner and faster than they ever have before. But at the same time, they're lasting for longer. And many of the fashion trends we see today were started almost 5 years ago at the start of the pandemic, whether it's trends you see in footwear or in trousers or in the type of material that consumers want. So the areas that I really call out as being very hot today would be denim, wide leg trousers, and also, the Western apparel trend. I cover a large national outfitter of cowboy boots and Western apparel, not only for true cowboys, but they're also seeing strong demand from a fashion-focused consumer. And what that company would say is that stores that they're opening in non-traditional Western markets, like the northeastern U.S., New York State, for example, are performing just as well as new stores that they're opening in what you would consider core Western markets like Texas or the South.
That's so interesting. And do you know what sparked it?
There are a variety of
but there was an
reasons,
investment made.
But there's certainly an investment made, and I think every brand is also potentially can benefit from tailwinds that are beyond their control. For example, changes in culture and the enthusiasm for country music that we've seen, not only from country artists, but from pop artists who have drifted towards country over time.
You're talking about Beyonce, aren't you? Yeah. Let's talk about inventories, because they become very important throughout various seasons, but certainly looking ahead to the holiday season, we've heard a lot of headlines about which ships are getting to port with things that would fill up inventories for those special dates and times where people are going to buy, even back to school. What is the picture of inventories at this stage for U.S. apparel?
Well, I think the picture for me is slightly concerning, and it's one that I'm going to be watching closely. But the nature of the concern has changed. Rewind to Liberation Day, I think the concern from analysts and companies in the space was that, with a 145% tariff on China, it will be prohibitively expensive to import goods into the US. And so many companies would either stop importing or they would just sit on their feet. And as they did so, the deadline at which they would have to order their goods for Christmas crept up. Yeah. And so there's a concern that we would have empty shelves in key categories like toys ahead of the holiday season. Fast forward to where we are today, tariffs on China are TBD, but as it stands, lower. And the primary concern now is that, in the data that I'm looking at, we've seen a significant pull forward of inventory by U.S. companies in the apparel sector into the U.S.
It's already there.
It's already there, and it's coming. For example, the data source that I look at, imports for the U.S. apparel sector year over year were up modestly in the single digits or low double digits in March and April, and that surged or accelerated to, I think, over 80% in May and almost 50% in June. And so we've seen this remarkable acceleration in inventory pull forward, which I'm monitoring closely, because historically, when inventories are growing rapidly, in prior cycles, that has had potentially detrimental effects for profitability, discounting, and gross margins.
Let's talk about discounting a little bit and just pricing power. Ultimately, through the pandemic, it was seen from an investment perspective, not maybe from a customer perspective, but from an investment perspective, it was great that companies could finally raise prices, because there aren't always that many opportunities, and when you get them, you take them, and that happened. Those have been sustained, as I understand it. Is there any shakiness there? Any concerns that the price rises that we saw either cannot be added to, which seems to be a tariff, one of the ways of dealing with tariffs, to just pile on the price. Just take us there a little bit. How are those prices holding? Because they have been raised already.
Certainly. When you look at the gross margins of many of the companies that I follow, both the brands that sell the product to the end consumer or the retailers that operate the physical stores, their gross margins are in many cases several hundred basis points above where they were pre-COVID. And so you've seen this remarkable expansion because they've discounted less and they've also taken their ticket prices higher. Is that sustainable? I think every company would tell you that it absolutely is. And all the companies that I've been speaking to this year have told me that, by and large, they are highly confident that they have pricing power and that they can pass on a significant degree of this tariff burden onto the end consumer. But I think history would suggest that that is not necessarily true, and there will be winners and losers. Because in an environment where headline prices across all goods, whether it's staples, whether it's discretionary items, are going up, I think the consumer probably has to make tough choices. And so the environment that I see playing out is, yes, some brands will have pricing power, the ones that I spoke to earlier, those with innovation, with brand heat, with strong management teams, and it will probably further separate the winners from the losers.
So really interesting stock picking opportunities, potentially.
I think so.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Tell us a little bit more about, the discounting story. So there are, you've studied and researched apparel quite a lot. Mm-hmm. That is where you see a lot of discounting and off-brand. Often companies will own their discount brand as well.
Yes.
How is that looking from, if you're investing in a company that has a very strong off-brand piece of their business? That's quite good, isn't it?
I think yes, to the extent that you do have a value line within your brand, or you have a private label segment as a retailer, that's certainly an opportunity. And I can think of several examples For example, in the sporting goods space, where many of the retailers that sell third-party sporting brands in the US also have a small but growing and very robust private label collection. And what they've been telling me is that demand is strong. They're very pleased with the performance of those goods. And the added kicker is that private label is often margin accretive to the tune of several hundred basis points.
Amazing. So. Okay. And then if they don't sell it, they can use it in their off-brand.
Right.
So
right.
Well, yes. Sell it off ultimately. So coming back to the tariff story, a lot of companies, even by the administration in the United States or others, have sort of either chosen, even been told to eat the cost, essentially, initially. Is that, in fact, what's happening? Or how are you seeing tariffs being distributed on U.S. apparel companies?
Yes, I think it differs based on the level of tariff that we end up with. But let's start with a low tariff, 10%. One of the Federal Reserve governors, in a speech he gave in June, outlined his general thinking around this issue based on his conversation with U.S. business leaders. And the framework was that of a 10% tariff, you can think of it, the distribution is roughly a third, a third, a third. A third is eaten by the Asian supplier in their profit margins. A third is borne by the U.S. company that's paying the tariff, and then a third goes on to the consumer. But I think
pushing prices higher.
Pushing prices higher. But based on my understanding of what profit margins are of the manufacturers, it's not clear that if tariffs go above 10%, the Asian manufacturer can bear more. Neither is it clear that the companies in the US will be willing to bear more of that burden. Right. And so my hypothesis is that to the extent that tariffs settle higher than 10%, you would see a greater and greater portion of that borne by the consumer, which could cause an acceleration in inflation in consumer goods.
So when you look at, you'll look at probably all data points, leading indicators and so on, but what do you watch most carefully for your purposes?
I think it's unemployment and inflation.
Right. Okay. And employment actually looks pretty good. It's obviously been sustained. It's leading to some of this. In the second half, you can't tell what the numbers are going to be on unemployment necessarily, but what are some of the either concerns or maybe good moments that you see in the second half? Because we have an awful lot of tariff news to go still. Mm-hmm.
I think on the employment front, the headline number is one that people point to as being relatively robust, and that's probably driven some of the consumer health and spending patterns that we've seen to date. But I think beneath the surface, many economists and analysts would say that there are things that they're monitoring closely. In particular, the fact that maybe private sector job growth within that headline unemployment number could ideally be a little bit stronger than it has been in recent months.
Okay, that's really interesting. I want to ask you about sort of the foot traffic versus all versions of e-commerce. This is a great question rolling in for you here. Cameron, we'll put this to you. Are virtual try-ons and augmented reality becoming mainstream in apparel retail? Any comments on how this is being used in inventory management or trend forecasting in retail? So the virtual and augmented reality story.
Certainly. I think virtual try-ons and in general, the technology that enables a richer, more comprehensive e-commerce experience is certainly helping in the apparel sector, where it's historically been incredibly difficult to find something that fits you. And the biggest evidence that it's working is that historically, 5 to 10 years ago, many of the mid-market to premium brands in my space were very hesitant to sell their product on large third-party e-commerce platforms. Right. The reason being is that the manner in which their product was presented was not consistent with that of a premium brand. Okay. They couldn't project the quality, they couldn't showcase to the consumer the amount of innovation in it. And what we've seen recently over the past 1 to 2 years is that many of the companies that I follow are now willing to list their product onto these large third-party e-commerce brands because the technology on those platforms has improved, and because those platforms' commitment to protecting the brand has improved. And then, just thinking about technology as well, it's not just augmented reality, but it's also artificial intelligence. Different AI, AR acronym is that many of the companies I follow are deploying that to enhance the consumer experience. And I can think of a online consignment platform in the US that is very excited about the technology that they've rolled out to market, whereby if you can text search a chatbot with exactly what you want, for example, Western outfit for wedding in the Southeast, or you can simply upload a picture of what a celebrity was wearing on holiday in Greece onto the platform, and it would come up with an entire wardrobe of second-hand items on that platform that you might want to buy. So it's technology and features like that are really helping these platforms bring more share of their business online.
That's great. The consumer, if we break it down into areas, we spoke a little bit about those that are more in a low wage situation, those perhaps feeling a bit of a wealth effect. You brought up something in your notes about, it actually has to do with administration policies, the ICE concerns about immigration. Some people maybe aren't shopping as much. Is that part of the research you were looking at?
And it's certainly something that I'm watching very closely, as are my companies. It's around the Hispanic consumer in the United States. And their willingness to shop, given the fear that when they're at the store, the ICE agents may roll in and disrupt their shopping experience. Let's say.
That's the concern.
And so none of the companies that I follow have said that it is a material issue to date through their observations.
Right.
But at the same time, it's something they're watching extremely closely, and it's something about which you hear anecdotes in our channel checks with private retailers. Not only a hesitancy to go to the store, but perhaps consumers are taking different approaches to shopping. For example, shopping at odd hours, late at night, or sending their children to the store instead. So those are just some of the anecdotes that have come from the channel checks, but nothing concrete to point to at the minute. So on the second half, are you worried or not? I mean, that's really the question. Mm-hmm. I think it's a matter of the second half being the economic picture, the consumer health picture being murkier than it has been for some time. But at the same time, I think I'm only spending a fraction of my time on tariffs and the macro. There's still extraordinary opportunity beneath the surface to find the winners and the losers within that backdrop.
There was a discussion, certainly, I think, in COVID and after that of people coming back and sort of the snapback trades and so on. But there was this discussion of stuff and less stuff, maybe, but better quality. I wonder, again, how that's playing out with maybe less brands, I don't know, you'll tell me, but then have bigger moats around them, more quality, sort of classic styles and things that people like to buy rather than just racking up the t-shirts type thing. There was a movement in there that we heard pretty significantly.
Certainly. I think there's several trends that could potentially play out beneath the surface. On one hand, there's the potential interest by especially younger consumers to be more conscious about their footprint and the volume of clothes that they buy and the length which they keep them and the amount that they send to the landfill. But on the other hand, I think there's a thesis to be made that in a weaker consumer environment, when people want to be more conscious about their wallets, they're going to look and invest in pieces of clothing that are potentially have more longevity, whether it's the quality of them or just the fact that they're less subject to fashion trends and are more timeless pieces.
And do you think that's also why some trends haven't changed as much? You mentioned that people will be aware of a new trend very quickly by virtue of communications being so much faster, but they might stick with it longer?
Potentially, yes.
Yeah. Part of it. What about the story of taking a look at sort of the in-store experience? Again, that was something that we thought, well, we can do everything online, we can do it, but how are the malls? Are they full? What's the foot traffic story?
Well, yeah, this is an issue I've been thinking about for a very long time. Prior to my role as a consumer analyst, I covered real estate. I was the U.S. REITs analyst for 3 years prior. And
malls,
so
go.
I think that the depth of the physical retail experience has been greatly exaggerated. I think in the U.S. This fear surfaced maybe 10 years ago, and I think there's certainly merit to the argument that there is physically too much retail real estate today in the United States. But at the same time, that hasn't meant apocalypse for everyone. It's just separated the winners from the losers. Right. And so you've seen it in the mall space where the B and the C and the D malls have slowly and continued to fade from the picture, whereas foot traffic, demand, tenant interest has concentrated in those A malls. And you see the same trend in my space currently in US apparel and specialty retailing, where you've had immense consolidation in many key categories, whether it's consumer electronics retail or sporting goods retail, where you have most of the bad players have gone bust, and the one or two scale players who have survived have attractive, healthy national retail footprints and differentiated retail experiences within that. And so you walk into some of the newer stores owned by one of the large US sporting goods players today, 100,000 square foot concept, climbing wall, golf simulator, premium customer service, and a premium assortment of products. And I think what the chaos of the real estate and channel shift has created is actually a stronger moat for some of these surviving retailers. And you have a virtuous cycle whereby if you're the last man standing, you're the only game in town. And if you have a great customer service and premium experience, the brands themselves that make the clothing will give you the best product. And that attracts more customers to the store and so on and so forth. And so there are winners within the disruption.
It's a pretty interesting sort of place we've gotten to through all that, because as you say, it was sort of a mucky time when there were so many malls and so much competition for that. Let's go through a couple of the other areas. So apparel is one, but also, what about everyone furnishing their homes? The idea of the restocking cycle of, phones. These things go in waves. They come in circles. They're very cyclical, really. Mm-hmm. Where are you in some of those? The home improvement side of things, also just, I guess, electronics broadly.
Right. Yes, I think investing is about understanding where these companies are in the cycle, and I'd say the furniture sector is interesting because you had this extraordinary boom during COVID.
Absolutely.
Everyone was staying at home,
everyone
wanted to furnish their home, and then you had the correction. And we've gotten to a place now where some housing analysts might argue we're bouncing along bottom in terms of housing turnover is at multi-decade lows, furniture demand is also subdued, and so to the extent that interest rates do go down, TBD, that could potentially create the opportunity for a cyclical inflection in not only housing but furniture demand.
Interesting. So it could be sort of getting poised for something there. On the consumer electronics side?
Mm-hmm. And I think similarly, there are cycles there, whether it's in mobile phones or gaming consoles or laptops or televisions. Right. I'd say that some of the companies in the consumer electronics space would argue that we're on the cusp of an inflection, if not of the inflection has already started in computers, for example, because the laptop replacement cycle is only so long, and you saw the last boom during the pandemic. And so now we've gone through this down cycle, and there's potentially, as technology changes, there's potentially more impetus on part of the consumer to upgrade their equipment at this point.
Okay, that's really interesting. So with just a couple of minutes left, what's sort of the message for the investor? It sounds like there are really interesting opportunities, but there's quite a lot of dispersion. Is that sort of one of the messages that you'd like to leave investors with today?
I think so. I think the consumer discretionary sector, in particular apparel and specialty retailing, is known to be extremely volatile with a very high amount of dispersion between the winners and the losers. And as the analyst, that creates a fair degree of stress and many sleepless nights. But for the firm and for our clients, that means there are always opportunities to invest along spectrum, regardless of what's happening in the macro, because it's a sector that is incredibly difficult to operate in. There are management teams that are capable, and there are management teams who are slightly less so. And so there's always going to be disruption and relative bets to make within that sector.
It must be such an interesting place to look, because you really are looking at sort of what people want. Is there any final thought on what do we not know that people want to buy right now?
I think it's just a matter of understanding where tariffs ultimately land. I think the market has gone through its cycles. There is an extreme amount of fear on Liberation Day. Now, I think the median stock in my coverage is actually up a mid-single-digit percentage since the day before Liberation Day. So the market seems to be, far less concerned than before about the impact of tariffs. But I think it's just a matter of watching very closely, how these deals settle out and what actually happens with the unemployment, the job market, and inflation on the consumer later this year.
Perfect. Cameron, so interesting to hear what you're researching. Thank you very much for sharing it with us.
Thank you, Pamela.
All the best.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.